The Veridion Briefing.
Welcome to the Veridion Briefing. I am Sloan Mercer with the Veridion Group, a private intelligence and security consultancy. This is a special edition, and today we are going to talk about a scenario that most people in commercial shipping, energy markets, and corporate security have been worried about for years, but that nobody has explained in a single place with the depth it requires. What happens if two of the world's most critical maritime choke points close at the same time? The Strait of Hormuz, through which roughly 27% of the world's oil exports, 20% of global liquefied natural gas, and up to a third of globally traded fertilizer transit, and the Bab el-Mandeb Strait at the southern entrance to the Red Sea, through which approximately 12 to 15% of global trade passes, connecting Asia to Europe via the Suez Canal. One choke point is controlled by Iran, the other is threatened by the Houthis, and those two actors are not independent. They are part of the same network, funded by the same financial infrastructure, armed by the same coalition of states, and pursuing complementary strategic objectives. If both close simultaneously, the consequences for global trade, energy markets, food supply chains, and military operations would be unlike anything the modern global economy has experienced. Today, I am going to walk you through the Houthi capability that most people have not heard of, the four nations arming them, the financial machine that pays for it all, and what the dual choke point scenario actually means for the world. Let me start with the capability that changes the threat calculus. Most people know the Houthis for their surface attacks. Missiles and drones launched at commercial shipping in the Red Sea. Between October 2023 and late 2025, the Houthis conducted more than 115 complex attacks on commercial and naval shipping. They launched missiles and drones at targets in Israel up to 2,600 kilometers away. They engaged in a 2-month military confrontation with the United States Navy. Red Sea shipping throughput decreased by 75% during peak disruption periods. But what most people do not know is that the Houthis are developing an undersea capability. Our intelligence assessment, published in February 2026, examines the Houthi unmanned undersea vehicle program. The designation we track is the Al-Qari'a concept, which reporting suggests may incorporate hybrid inertial navigation and Doppler velocity log systems. In plain language, that means a drone that can navigate underwater without relying on GPS. That matters because GPS jamming is one of the primary countermeasures available against unmanned systems. If you can jam GPS, you can blind a drone. But a system using inertial navigation and Doppler velocity log does not need GPS. It navigates by measuring its own movement relative to the seabed. That makes it materially harder to defeat with electronic warfare. There are additional reported capabilities, including burst mode acoustic activation protocols, that would allow the device to sit concealed on the seabed for extended periods with minimal electromagnetic signature and potential acoustic inertial masking that reduces its detectability by sonar. We assess these technical claims at moderate confidence because they require forensic validation that is not available in the open-source evidence base, but the trajectory is clear. The Houthis are advancing from crude surface weapons toward more survivable subsurface platforms, following the same pattern they demonstrated with their drone and missile programs. Start crude, iterate, improve, and eventually deploy something that works. The most relevant confirmed interdiction was conducted by USCGC Clarence Sutphin Jr. in January 2024, when U.S. Central Command described the seizure of unmanned undersea vehicle and unmanned surface vehicle components and other materiel bound for Houthi-controlled Yemen. The reporting indicates component concealment techniques, including advanced seekers and other systems disguised within civilian generator housings. That is a sophisticated smuggling methodology that tells you this is not an amateur program. Now let me tell you who is arming the Houthis, because this is not just an Iran story. It is a four-nation story, and the evidence is documented in official U.S. government designations, United Nations reporting, and credible investigative journalism. Iran is the primary enabler. This is well established and requires minimal elaboration for this audience. The Islamic Revolutionary Guard Corps Quds Force provides technical support, designs, components, and personnel for Houthi weapons programs. The financial infrastructure runs through IRGC-QF channels. The logistics facilitation network operates through designated intermediaries. Iran is the backbone of the Houthi military capability, and that relationship extends to the Undersea program. What is less well known is the Russian dimension. In April 2025, the U.S. Treasury Department designated a network of Houthi financial facilitators and procurement operatives who had procured tens of millions of dollars worth of commodities from Russia, including weapons and sensitive goods, as well as stolen Ukrainian grain, for shipment to Houthi-controlled Yemen. Russia-based Afghan brothers Hushang and Sohrab Gairat orchestrated at least 2 shipments of stolen Ukrainian grain from Crimea to Yemen. A Russia-flagged vessel, the AM Theseus, transported the grain. A Turkish-based Iranian money launderer arranged payments worth millions of dollars in support of these shipments. But the Russian involvement goes beyond procurement. According to Wall Street Journal reporting, Russia provided targeting intelligence to the Houthis to assist in striking commercial shipping in the Red Sea. Russian satellite data was used to expand Houthi targeting of commercial vessels. IRGC personnel embedded with the Houthis reportedly passed Russian data to the group. CNN reported that Russia deployed military advisors to Yemen, with U.S. officials watching as large Russian ships made an unusual stop in the southern Red Sea, where Russian personnel disembarked and were ferried to Yemen by Houthi boats. And Russian arms trafficker Viktor Bout, released from U.S. custody in a 2022 prisoner swap, was reported to be negotiating a deal to sell $10 million in small arms to the Houthis. Russia has also considered supplying the Houthis with advanced anti-ship cruise missiles, including the Yakont and Bastion supersonic systems. Saudi Arabia and the United States intervened to prevent at least one planned delivery. But the intent is documented. Russia views arming the Houthis as a way to distract and deplete U.S. military resources, tying down naval assets in the Red Sea that might otherwise be available for other theaters. China's role is the most extensive by volume and the least discussed in mainstream coverage. According to analysis of interdicted Houthi weapons and components, 35% of all documented items between 2021 and 2025 originated in China, primarily components and raw materials. That is more than Iran, which accounted for 21%. China is the single largest source country for Houthi weapons components by documented volume. In October 2024, the United States sanctioned 2 China-based companies, Shenzhen Rayong Technology and Shenzhen Jinghong Electronics, for providing dual-use components to the Houthis, including hundreds of advanced missile guidance system components. In April 2025, the U.S. State Department accused a Chinese satellite firm, Changguang Satellite Technology, of providing imagery to help the Houthis target U.S. warships and international vessels. The company reportedly had 100 satellites in orbit, with plans for 300 by the end of 2025, giving it the capability to provide repeat imagery of any location in the world every 10 minutes. Houthi leaders visited China in 2023 and 2024 to establish supply chains. Maritime data confirms that Chinese-associated ships continued navigating Red Sea shipping lanes without being targeted by the Houthis, suggesting an implicit arrangement. The Houthis have publicly stated they would avoid targeting ships linked to China, which purchases 90% of Iranian oil exports. The strategic logic from China's perspective was articulated by Elbridge Colby, the Undersecretary of Defense for Policy, who asked, "Why would China help us address the Houthi problem when it obviously distracts and depletes us?" For China, Houthi disruption in the Red Sea ties down U.S. naval assets, raises shipping costs for Western economies, and creates leverage, all while Chinese vessels transit unmolested. North Korea's contribution is less direct but structurally significant. North Korean ballistic missile technology has been exported to the Middle East for decades, and that technology pipeline runs through Iran to the Houthis. C-802 anti-ship missiles, designed in China and manufactured in Iran, were fired by the Houthis in 2016 at naval vessels. North Korean tunneling technologies and missile design knowledge have contributed to the broader proliferation ecosystem. The CRINC alignment, China, Russia, Iran, and North Korea, functions as a mutual support network where each member contributes what it has. China provides components and intelligence, Russia provides targeting data and weapons procurement, Iran provides design expertise and assembly, and North Korea contributes missile technology and, increasingly, manpower for Russian operations that indirectly benefit the Houthi network. Now, let me explain how the Houthis pay for all of this, because you cannot run a weapons program without money, and the Houthis have a lot of it. U.S. Treasury Department assessments establish that the Houthis generate over $2 billion annually through illicit oil sales and related networks, despite sustained sanctions pressure. That is not a small insurgent treasury. That is a revenue base comparable to the GDP of some small countries, and it funds procurement, operations, and the iterative weapons development cycle that has made the Houthis progressively more dangerous over the past decade. The financial infrastructure operates through what we describe as a digital hawala bridge. Illicit oil revenue flows through commodity trading networks and associated financial facilitation. Cryptocurrency rails, particularly Tron-based stablecoin transactions, provide the settlement layer. In January 2026, OFAC-designated ZSEX Exchange and Zxion Exchange, along with specific Tron blockchain wallet addresses, for processing over $94 billion since August 2022 in transactions that included Houthi-related flows. This is the same crypto hawala infrastructure we described in our earlier briefing on illicit finance. The Houthis are not operating a separate financial system. They are plugged into the same global sanctions evasion architecture that serves multiple threat actors. Designated exchange infrastructure reconstitutes through successor entities within months of enforcement action, which is why the probability that designated entities will rebuild operations within 6 months is assessed as likely based on historical adaptation patterns. Now let me address the scenario that should keep every supply chain manager, energy trader, and defense planner awake at night. The Strait of Hormuz and the Bab el-Mandeb Strait are connected not just geographically, but operationally and strategically. Iran controls one. The Houthis, as Iran's most capable remaining proxy, threaten the other. If both close simultaneously, the consequences cascade through every dimension of the global economy. Start with the numbers. The Strait of Hormuz handles roughly 27% of global oil exports, 20% of global LNG exports, and 20 to 30% of global fertilizer exports. The Bab el-Mandeb and Red Sea corridor handles 12 to 15% of global trade by value, including a significant share of container shipping between Asia and Europe. Combined, these two choke points carry a disproportionate share of the world's energy, food inputs, and manufactured goods. If both close, the rerouting problem becomes nearly unsolvable. When the Red Sea alone was disrupted by Houthi attacks, ships rerouted around Africa, adding 10 to 14 days to the typical 30 to 40-day Asia to Europe voyage. That was painful, but manageable. But if the Strait of Hormuz is also closed, the oil, LNG, and fertilizer that normally flows out of the Gulf has no maritime exit at all. There is no Africa route for Hormuz. The strait is the only sea passage connecting the Persian Gulf to the open ocean. Saudi pipelines can move some oil overland, but the capacity is a fraction of what transits by sea. The economic impact of a dual closure would be measured in trillions, not billions. Oil prices would spike immediately and severely, potentially doubling or more from pre-crisis levels. Natural gas prices, already elevated by the Iran war, would surge further as Gulf LNG exports halt completely. Fertilizer supply, which we documented in our January assessment as a critical vulnerability, would face the most extreme disruption since synthetic fertilizer became the foundation of modern agriculture. The food security implications would be global and acute. We have already seen urea prices surge 50% from the partial Hormuz disruption caused by the Iran war. A complete dual closure would push fertilizer prices to levels that make 2022's crisis look modest. The World Food Programme has already warned of 45 million additional people facing acute food insecurity from the current disruption. A dual closure would multiply that number. For military operations, the dual closure creates a force allocation nightmare. The U.S. Navy would need to simultaneously protect Hormuz-adjacent operations, maintain Red Sea presence, and potentially escort commercial shipping around Africa on vastly extended routes. Carrier strike groups, destroyer escorts, and logistic ships would be stretched across an operational area spanning from the Persian Gulf to the Cape of Good Hope. This is exactly the strategic objective that Russia and China see in supporting the Houthis, forcing the United States to spread its naval forces across an impossibly wide area, reducing the concentration available for any single theater. Insurance markets would effectively collapse for the affected regions. Maritime insurance premiums, already elevated from the Iran war, would become prohibitive for any vessel transiting within several hundred miles of either choke point. Commercial shipping companies would refuse to route through the area regardless of insurance availability, creating a self-reinforcing closure even if military escort were theoretically available. The timeline for economic impact would be measured in days, not weeks. Oil markets move on futures within hours. Fertilizer markets, which are less liquid, would spike within days. Container shipping rates would adjust within a week. Consumer price impacts would begin appearing within 4 to 6 weeks for energy and within 2 to 3 months for food. Our assessment is that the probability of a simultaneous dual closure remains in the lower ranges because Iran would bear enormous costs from closing Hormuz, including to its own remaining economic lifelines and those of its regional partners. But the capability exists, the intent is documented, and the network of supporting states, Russia, China, and North Korea, each benefits from the disruption that a dual closure would cause to Western economies and military posture without bearing the direct costs. The Houthi Undersea Vehicle program adds a new dimension to this calculus. Surface attacks on shipping can be countered with naval escorts and defensive weapons. Mines can be swept. But autonomous undersea vehicles that can navigate without GPS, conceal themselves on the seabed for extended periods, and activate on command represent a qualitatively different threat that existing countermeasures are not fully designed to address. If the Houthi UUV program matures even to a modest operational capability, it adds a persistent subsurface threat layer that complicates every aspect of military and commercial navigation through both choke points. The bottom line is this: the Houthi threat is not a regional nuisance. It is a node in a four-nation network designed to challenge Western maritime dominance at the world's most critical choke points. The weapons are supplied by China, Russia, Iran, and North Korea. The money comes from a $2 billion annual revenue machine laundered through cryptocurrency. The strategic objective is to tie down U.S. naval forces, raise the cost of global trade, and create leverage that benefits every member of the supporting coalition. And the next generation of Houthi capability, unmanned systems that operate beneath the surface without GPS dependence, threatens to make the problem materially harder to solve. Organizations with supply chain exposure through either choke point, energy market exposure to Gulf production, or personnel in the broader Middle Eastern maritime corridor should be planning for dual closure scenarios now, not when they materialize. The time to hedge, reroute, and build contingency plans is before the crisis, not during it. That is the Veridion Briefing special edition on Houthi undersea capabilities and the dual choke point threat. The full analytical product with complete sourcing, the financial infrastructure map, technical capability assessment, alternative scenarios, and indicators for monitoring is available through the Veridion Group. If your organization needs maritime security intelligence, supply chain risk assessment, or choke point exposure analysis, visit veridiongroup.com/briefing to schedule a consultation with our analysts. I am Sloan Mercer with the Veridion Group. Stay informed, stay prepared. I will see you next week.